Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is American International Group, ticker AIG. Over the next 5 minutes, you will learn what I think about both the valuation and the business quality for this business. So AIG is pretty well known. It is an insurance company, and it had a very big problem during the financial crisis. So you can see here a little bit in the business description. They provide insurance projects for commercial, institutional, individual customers in North America and internationally. This is a huge business. Again, $50 billion market cap. Absolutely gigantic company that has insurance in many different areas, whether it's commercial, industrial, energy related, aerospace, political risk, travel insurance, life insurance. They run the gamut in terms of insurance. Beta doesn't really tell us much, and share turnover doesn't tell us much. But what we need to address is the return on equity. So for many years until the financial crisis, this looked like a really good business, as you can see here. So you had 10%, 13%, 12%, 11%, 13%, 5%. But then in 2008, they had negative 118%. Basically, the company had a massive wipeout, was rescued by the United States government, and then has been working to recover ever since. And so you can see them jumping around with some losses since then. So they lost money in 08 and 09. And then they managed to stay profitable until 2016. They lost money in 2017, lost money in 2018, lost money again in 2020, and then they were profitable in 2021. So when you look at this, on the whole, this looks bad. It's not a company that I necessarily would want to be invested in. And what you really need is you need time for this business to recover. And I'm not sure it's ever going to fully recover because they lost a lot of the appeal. One of the appeals of a big, strong insurance company like AIG, which is exactly what it was before the financial crisis, is that name brand, that appeal, that security caused people that needed heavy, strong insurance companies to come to them. So if you had a big need, you could go to AIG. They were the name brand insurance company you could trust. Well, that's been lost, and it's really hard to ever gain that back. So you really going to have to wait, another decade for the financial crisis to fall off, for them to have 10, 15 straight years of profits before they build that back. Now, what you see here is the 10-year median returns have been terrible. And so it's not going to really tell us much because we know this is terrible. This company's been working through a backlog of bad businesses and liabilities, and it's going to take time for that to improve. And so the return on assets, return on equity, and return on investment are all not worth investing in. Likewise, your 10-year CAGRs are all going to look bad as negative because they've had a bad 10 years, going from $71 billion in revenue down to $51 billion. But that's not really what matters. What really matters is your earned premiums. And so you see the premiums have also declined from $38 billion down to $31 billion. So you're not getting growth, so you need a cheap price. Now, at least on the surface, it appears to be a cheap price with a PE of 5.3. That sounds cheap. The problem is when we look at EPS, so what's our share price? $61. So if you look at EPS in 2021, you have an EPS of $10, but the previous year you lost $6. So even just averaging out those, then the PE drops, then the earnings drops to maybe $4 if you average those 2 years, and then you're at a PE of 15. If you average the last 3 years, it's still $4. But if you keep averaging in, 2016 through 2018, now it's even smaller than that. So your price is actually quite high. The big question then becomes, is $10.82 a real reasonable price to pay? And it's really hard to tell. You certainly won't be able to tell based upon a 5-minute analysis. So if you are interested in this company, it's going to require a lot of additional work. And the problem with that is the more work that's required, the less likely is someone else is going to be interested in buying it. And so you can see they've been buying back shares. The shares diluted has been dropping over time. Let's look at the cash flow statement to see that. So you can see that they're buying back their shares and using some of that excess money. Now they have a pretty positive cash flow from operations besides this 3-year period from 2017 to 2019. That's a good sign. And then they're able to use that to invest and then also buy back some shares. And they've been paying back debt and everything along those lines. Let's look at the debt makeup here. So your long-term debt has dropped significantly. That's a good sign, even though their total assets has held up well. And so that's a good sign for what the future might hold in this business. It's just really difficult to project here. So what do I think? Well, you want to buy this company cheap. And so if we think this 10-year premiums CAGR is representative of the business, then in order to justify a no-growth business, you're going to buy it like a PE of 8. And if it's losing 2% a year, maybe you buy it a PE of 5 to 6. So this number looks reasonable. It looks like it could be a cheap price. Again, if this $10.82 per share is accurate of what we can expect going forward, then I feel good about the price today, and AIG can be attractive. But if it's actually an overstatement, which it appears to be over the last 10 years of history, then you're paying way too high of a price because the PE is actually 15, 20, 25, something higher than that. And so it will require more assessment here. I don't like the quality of this business anymore because they've been unable to be routinely profitable like they were in the past. The return on equity is too low. The return on assets is too low. And there's business really isn't investable until it continues to clean itself up and can return to growth. So for me, AIG is a pass. And if you learned something from this, feel free to write in the comments what I was missing. If you like this video, hit that like button, and don't forget to subscribe and hit the bell so you can get notifications as I submit new videos. Thank you for listening. Until next time, stop paying fees, start building wealth.